What's going on, guys? It's Jimmy. Let's talk about what the Fed is saying and what they're doing. Is that we might be seeing 10% plus mortgage rates coming soon here, and even higher interest rates on credit cards, car loans, personal loans, and everything coming here soon. And if we look back at history in the past and stagflation of the 1970s, things might be getting a lot worse than they already are now. And remember, we're already seeing the worst interest rates of this entire century right now, and things could be getting even worse. Remember that the Fed is already telling us that we're pretty much seeing stagflation right now. Stagflation is already where inflation is not going down, it's dragging along for an extended period of time, very similar to what we've seen in the 1970s. I'm going to show you on a graph what happened back then, what is happening now. And the Fed is very concerned about this, okay? And what happened back then is inflation dragged on for so long that they had to keep raising interest rates. And when they raise interest rates, it affects pretty much everybody, okay? Anybody that has any type of debt. This is for car loans, this is for mortgages, this is for credit cards, this is for personal loans. This affects almost the entire United States, or pretty much everybody. And really not just the United States as well, but the entire world, okay? Central banks across the world, United Kingdom, Europe, even China, everywhere has been raising interest rates, okay? And the problem here is that inflation is not going down, okay? So take a look at this picture I seen while browsing social media of just some inflation items. Change in prices since 2019 by food item. Cocoa up 345%, orange juice up 260%, olive oil up 219%, sugar up 120%, fruit snacks up 77%, cooking oil up 54%, chocolate bars up 52%, applesauce up 51%, beef up 51%, mayonnaise up 50%, loaf of bread up 42%, eggs up 40%, milk up 40%, cereal up 38%, and butter up 24%. And yet they want to give people on Social Security, fixed income, and seniors a 3% raise. See the problem? There's 70 million people on Social Security and fixed income. You guys can let me know your problem, or let me know your problem. Let me know your thoughts here in the comment section. And the Fed and Jerome Powell, the head of the Fed, says progress on inflation has stalled. They have paused raising inflation for the time being. They wanted to cut rates, but they can't because inflation will not come down. The question here, will they have to actually start raising rates again because, well, their job isn't finished and, well, inflation just will not go down? The reason they had to actually start raising rates because of how bad inflation was. And a lot of people think that they may have to do this again because exactly what the Fed is telling us is that inflation will not go down. And it's actually getting worse because we continue to see prices go up and up and up. Stagflation. And if you look at interest rates here, this is the 30-year fixed rate mortgage average in the United States. This is over the last, this is back since 1970, so over the last 50 years. You can see here in the corner here to the right, interest rates have been steadily increasing here since basically since the pandemic, since 2020 here. Take a look. Look how sharply they have been going up. I mean, we went from 2 point something interest rates, 2 point, what is that, 2.5, 2.6%. And look how just skyrocketed they went up. In fact, if you go to Google and type in mortgage rates, with the average home price, which is over $400,000, pick a state, and with a 700 credit score, 680 to 695, 30-year fixed mortgage rate is about 8% now. Pick a state again, go to California, and remember, you can't even probably buy a home in California for $400,000. Almost 8%. 8%. Good luck buying a home in California for $400,000. You guys can let me know your thoughts in the comments if you live in California. Let me know how much home prices are there. Same thing with New York. Look at that. 8% on the nose. And this is with a 700 credit score. Go even lower, 660 to 680. It's over 8%. Over 8%. And remember, when we look at this graph here, look at the trend. Look at how it's just going up, okay? When we see that the graph is just going up and up and up, will this trend continue? Will we see a 10% mortgage rate here in the near term? Will the Fed have to continue raising rates? Let's go back here to what happened here in the 1970s here, the last time we had stagflation like this, where we were actually at 7% interest rates here in the early 70s, 1972, 1973, 1974. We were at, look at this, 7.3, 7.4, 7.5% interest rates. And what happened here is that the Fed had to start and continue to raise interest rates because inflation kept dragging on and kept going up. And mortgage rates actually went from 7.5%, as you can see on this graph here, to 8%, and then to 9%, and then to 10% here in 1974. And then they actually kind of mellowed out here a little bit and went back down to 8%, 9%, 8%. And then stagflation just kept going on. Interest rates kept going on to 8%, 8.7%, 9%, all the way into 1978. So 6 years actually went by, and we were dragging along at 8, 9% interest rates. Okay, so remember, we went from 7.5% to 8%, 9%, 9% interest rates here, kind of dragging along. The stagflation dragging inflation and interest rates of the 70s. And then inflation and interest rates kept dragging along and actually getting worse. Does this kind of sound familiar? And all of a sudden, the Fed and inflation dragging along, getting worse, and things just kept getting a little bit worse and worse. And all of a sudden, things popped. And we get into the early 80s, 1980. I was actually born in 81. I'm 43 years old, okay? 1980, inflation gets, mortgage rates get to 16% interest rates. They drop a little bit, probably because of the sudden shock of it, and then go back up to a high of around 18% interest rates. And again, you'd have to go back and, maybe you had a mortgage back then. Maybe you could let me know your thoughts in the comments if you remember this stuff. But my guess is that this was the prime interest rates, or, the mortgage interest rates. If you probably had, maybe not the best credit, maybe they were actually even a little higher than this. Maybe there were 20% mortgage rates out there, okay? So 18.6% mortgage rates in 1981 is just absolutely crazy. And to give you an idea here on how bad this is, on a $400,000 home, which is the, roundabout average price for a home today, on a 3% interest rate, which you could get a few years ago. Remember, just showed it to you. A lot of people know this. Some people have their homes locked in on this. On a $400,000 home, 3% interest rate was about $1,686. We'll round to $1,700. You could get that 3% interest rate a few years ago. Now, at an 8% interest rate, it's $2,900, almost $3,000. The difference here, going from 8% to 3%, you go from $1,700 to, just shy of $3,000. I mean, that's a huge difference. I mean, look at that. Going from, we'll just round up here on both of these, $1,700 to $3,000. That's $1,300 more in interest per month, every single month. Now imagine if we go to 10% interest rates, that's $3,500 a month. $3,500 a month, okay? Now remember, back in the 70s, homes were what? 100,000? They were what? 70,000? Not 700,000, but 70,000? They were what? 50,000? I mean, those payments at, 10% interest rates, or higher, they were minuscule, right? These homes weren't $400,000. And at a 18% interest rate, look at what a $400,000 loan is going to cost nowadays, $6,000 a month on a $400,000 loan. And remember, in some areas of the country, you can't even buy a home for $400,000. Homes are way more than that. Way more than $400,000. You can see right here, this is a, 30-year mortgage at 18% interest rate. This is what homes were at 18% in the 70s. So to think that this is unrealistic, you're going to see people in the comments say, guess what, Jimmy? Back in the 70s, I had a mortgage for 18%, or I had a mortgage for 16%. And we're at 8% right now, as you can see here on the screen. There are people getting 8% mortgages right now, hoping that interest drops in the future so that they can refinance, and then they got to pay thousands of dollars just to do the refinancing. And all this just rings up the dollars in fees, refinancing fees, or mortgages, or interest every month. And all this is just costing the American dream, the American dollar, everything. And don't forget the government blowing hundreds of billions of dollars a year in interest. It's almost $1 trillion a year in interest, with the interest rate going up every month or so. Who knows what it is? It's hard to even keep track on the figure because it's literally changing all the time. So we better hope that 10% mortgage rates don't come. Don't forget, credit card interest rates are at all-time highs, nearing 30%, and they can raise it on you at any given time. You got to check your statements like a hawk. If anything, pay down your credit card bills, your credit card statements. That's always the first thing you want to try to pay down, because those are the highest, APR, the highest debt you have. That's the worst thing you want to charge up. So let me know your thoughts here in the comments. I'll keep you up to date here with everything happening here in our country on a daily basis. Make sure to subscribe down below. Click the bell icon. It's completely free. It's the best interest rate around here, 0. And I will keep you up to date. Thanks for liking. Share this video with anybody that needs to hear this information. Click here to see new Social Security and Medicare changes, or click here to see a new stimulus that the government is preparing to inject a massive $1 trillion into the economy. Thanks for watching, and I'll see you in the next video.